In today's video, we're getting into Dan Ives' latest take on the top 5 tech names to own heading into 2026. Dan Ives is the global head of tech research at Wedbush Securities, and he joined CNBC's Fast Money to break down which stocks made his 2026 tech list, and which big names did not. And one of the most important lines he dropped in this interview was this: the AI revolution is moving beyond NVIDIA, and that's exactly why he's still bullish on tech. Here's how we're going to do it. First, I'm going to play you the actual clip of Dan Ives on CNBC. Right after that, I'm going to come back and give you my own detailed reaction and breakdown of what he said, in plain English, so you can understand what it means for your portfolio and for the broader market. Then after that, I'm going to give you an in-depth analysis of the top 5 tech names to own heading into 2026, based on Tom Lee's picks, so you can compare the logic, compare the themes, and see how these two viewpoints line up or where they diverge. Hit the like button, let's push this one to 1,000 likes, share the video, and let me know your thoughts in the comments. Also, subscribe to the channel so you do not miss the next important investing update. Now, let's hear what Dan Ives had to say.
Wedbush Securities today out with its top tech names to own into next year, among them Microsoft, Apple, Tesla, Palantir, CrowdStrike. One name that you're not seeing on that list? NVIDIA. Dan Ives behind the call. He is the global head of technology research, and I have to issue the biggest correction in the history of my career, which is now that you're in the light, that jacket is not McLaren papaya. It is, I would dare say, peach.
Look, I mean, I'll take both sides. Again, you never...
That vital correction now aside, why is NVIDIA not on your tech names to own next year, Dan?
Yeah, look, it's still, still in our Ives AI 30, a top tech name, but ultimately, to me, in terms of the 5 that stick out, it's really about how do you play the AI revolution on the hyperscaler? How do you play it on the consumer in terms of Apple? How do you play it on enterprise with names like Palantir, CrowdStrike, cybersecurity? Brian, I view it as like NVIDIA, there's only one godfather of AI, it's Jensen. We'll see him next week at CES. But the derivatives, the second, third, fourth, just starting, which is why we're so bullish in tech.
You're in the Hall of Fame, Dan, regardless of color, although Oscar Piastri just emailed me and mentioned that he actually thinks the color is a McLaren papaya.
Well, there you go.
With that said, what does Palantir, what do their revenues need to be? They're going to do $6.5 billion of revenue next year to justify a $500 billion valuation, in your opinion.
Yeah. Look, to me, and we've talked about it a bunch, it's that it's ultimately it's the commercial business that I believe could ultimately be $2-3 billion when I see it playing out. I think when you actually do the trajectory here, I think numbers where you see for Palantir in 2026, I think they ultimately double over the next 3 to 4 years. And it speaks to the point. Super expensive stock today. But I just view it, I think it's $1 trillion valuation in the next 2 or 3 years as the AI revolution plays out.
So everyone knows you for these marquee names. And when you go into CES, what I always look at are a portfolio of names that are going to shock people. Something that shows up. If you search anything with CES, you'll see robotics come up. What are the names you see you meet with everyone, both private and public companies? What companies are going to, A, be there and have impressed you already?
Yeah, I think when it comes to robotics, I think maybe like a off-the-radar name that we're bullish, Serve, like Serve AI. When you look what they're doing on robotics on the delivery side, what I view is actually true autonomous playing out. They'll be there front and center. And look, Steve, to me, it's really like the autonomous is going to be front and center here. It starts what Jensen's going to lay out, but this speaks to autonomous robotics is going to be key to what I view as and that's one of the core names.
All right, Dan, talk to us about RPOs. This is not the run pass option. This is remaining purchase obligations here. Not something that I think a lot of folks were talking about too much until this summer when we saw, that huge OpenAI contract with Oracle, and a lot of investors were really excited. And, as an analyst, though, you see this big number, right? You see a $500 billion purchase obligation. How do you think about that? It's not in your numbers, right? But it helps kind of formulate how you're thinking about future revenue. To me, the market called BS on this with Oracle. And how do you think about it? Is this something we're going to see? Maybe some of these contracts not come to fruition.
Look, I think we sit here a year from now. I think actually one of the names that's going to stick out is is sort of the renaissance that's going to happen in Oracle. Because to me, when I look at what's happening, where they play from the stack play, where they play in terms of the AI revolution, I think investors are wrong to call out that this RPO, what I've ultimately, a re-acceleration of growth, that's going to go from 18% to 30% to 45%. I think 80 and 90% of that gets done. So to me, would I take out 5% debt if I had a 100% chance to ultimately do what they could do? Yeah, and I think that's what they're doing. I think that's why Oracle, to me, right here, it's a $78 upside, $15 downside, risk reward.
The conversation opens with this idea of a broadening out away from some of the names that have been huge contributors to the S&P 500, not just on earnings, but also on performance. Translation, the market is starting to look past the same usual suspects that everybody crowded into. When a market broadens, you often see money rotate into second and third order winners, and you start seeing different subsectors participate. That matters because it changes how you build a portfolio. Instead of only asking which megacap is going up, you start asking where is the next pocket of upside as AI spending and adoption spreads. Then you get the headline that Wedbush put out its top tech names to own into next year, and the list includes Microsoft, Apple, Tesla, Palantir, and CrowdStrike. And the host immediately points out the one name missing, NVIDIA. That is not a small omission because NVIDIA has been the poster child for AI infrastructure. So the obvious question is, why leave it off if you are bullish on AI? Dan's answer is more strategic than it looks on the surface. He is basically saying NVIDIA is still central. He even frames it as the godfather of AI with Jensen Huang. But his list is trying to highlight how to play the AI revolution through multiple lanes. In his mind, NVIDIA is the foundational layer, the picks and shovels, the enabling platform. But the next phase for investors is about the derivatives, meaning the second, third, and fourth wave beneficiaries that start to surge once the foundational infrastructure is in place. So he breaks it down into buckets without labeling them as buckets. He talks about hyperscalers, the consumer angle, and enterprise, and he drops cybersecurity into that enterprise conversation. When he says hyperscalers, he is talking about the companies building and renting out the AI infrastructure at scale, the big cloud platforms, the large cap platforms that are spending massive money on data centers, chips, networking, and AI services. In his top 5, Microsoft is the clean representation of that because Microsoft sits at the intersection of cloud, enterprise distribution, and AI productization. In other words, it is not just about building AI, it is about selling AI into the installed base. Then he talks about Apple as the consumer play. And that is important because it signals the next big narrative shift. The AI story started as infrastructure. First you build the factories, then you start shipping the products made in those factories. Apple is a way to express the idea that AI is not just a data center phenomenon. It is going to hit devices, workflows, personal assistants, and daily consumer experiences. Even if people argue about how fast that monetizes, the market loves the concept of AI moving from back-end to front-end, from servers to pockets. Then he pivots to enterprise with names like Palantir and CrowdStrike. This is the part retail investors sometimes miss because it is less flashy than chips and consumer gadgets, but it is where the recurring revenue tends to live. Enterprise AI is where companies pay for software that helps them make decisions, automate processes, detect threats, and improve productivity. If the hyperscaler layer is the highway system, enterprise software is the fleet of trucks, logistics, and business operations that actually moves value across that highway. CrowdStrike in particular is Dan saying cybersecurity is not a separate theme, it is fused into the AI theme. As companies adopt more AI tools, spin up more cloud infrastructure, and connect more data, the attack surface expands. Cybersecurity becomes a must-have, not a nice-to-have, and AI itself becomes both a weapon and a shield. Threat actors use AI to scale attacks. Defenders use AI to detect anomalies faster. That tug of war tends to drive sustained spending, and that is why cybersecurity keeps coming up as a durable AI-adjacent category. Now let's talk about the NVIDIA omission again, because that is the key nuance. Dan is not saying NVIDIA is not great. He is saying that if you want a list that highlights where the next incremental excitement could come from, you start looking at the companies that monetize AI at the application and workflow level, and the companies that benefit from AI diffusion across the economy. NVIDIA is the core, but once the core is understood and priced in, investors hunt for the next narrative layer. And that is exactly what he means by second, third, and fourth derivatives just starting. This is also why he mentions we will see Jensen at CES. He is reminding everyone that NVIDIA still sets the tone. In a lot of ways, NVIDIA's messaging becomes the macro signal for AI. If Jensen is confident about demand, roadmap, and platform expansion, the market often takes that as validation not just for NVIDIA, but for the entire AI complex. So even when NVIDIA is not on the specific list, it is still the gravitational center of the theme. Then the host pushes him hard on Palantir, and this is where the interview gets really practical for investors. The host is basically saying, okay, Palantir has become a marquee AI name, but the valuation expectations are massive. In the transcript, the host frames it like this. If Palantir is going to do about $6.5 billion in revenue next year, what would revenues need to be to justify something like a $500 billion valuation? That is the underlying challenge. At some point, the story has to turn into numbers that make sense. Dan's response is revealing. He does not pretend it's cheap. He basically admits it is super expensive today. But he argues the reason you pay up is because the commercial business can scale, and he sees that commercial segment becoming $2 to $3 billion as the trajectory plays out. And then he goes one step further and says he thinks the company could double over the next 3 to 4 years. He is essentially saying, yes, it is expensive, but the growth curve could be steep enough, and the AI narrative strong enough that $1 trillion valuation in the next 2 or 3 years is plausible in his framework. Now, whether you agree or not, that is the debate investors should be having. Not, do I like Palantir, but what is the pathway from today's revenue base to the kind of scale that makes the valuation rational? When analysts talk like this, they are implicitly assuming a few things. 1. That demand for AI-driven decision platforms expands rapidly across industries. 2. That Palantir maintains pricing power because it is not a commodity product. 3. That they continue converting pilots into long-term contracts. And 4. That margins improve as the platform scales. Because valuation is not just revenue, it is what you keep after costs. Here is my take for your portfolio mindset. When a stock is priced for perfection, the upside can still exist, but the margin for error shrinks. Any slowdown, any guidance miss, any competition pressure, any government contract noise, any change in the narrative can hit the multiple. So if you are playing a name like Palantir, the job is to separate story from execution. Watch customer growth, watch net retention, watch deal size, watch how fast commercial revenue is compounding, and watch whether the AI product momentum is translating into repeatable sales, not one-off headlines. That is the difference between a great story and a great business compounding. Then the interview shifts into CES and the names that shock people, and you can tell the host is trying to pull Dan into the next frontier beyond the obvious mega caps. Robotics shows up because robotics is one of the most natural physical world extensions of AI. In plain language, once you have intelligence, the next step is embodiment. Software that can reason is powerful, but software that can also act in the real world is a different level of impact. Dan mentions an off-the-radar name he is bullish on, Serve AI, and he frames it through delivery robotics and what he calls true autonomous playing out. The key phrase here is true autonomous. Investors hear autonomous and they immediately think self-driving cars, but the concept is bigger. Autonomy includes robots in warehouses, last-mile delivery robots, industrial automation, and even specialized service robots. The reason this matters is because robotics can turn AI from an insight tool into a labor tool. It can reduce cost, increase speed, and solve workforce constraints, and that is why CES becomes relevant. CES is not just gadgets. It is often where narratives get seeded, partnerships get hinted at, and the market starts pricing future categories before they show up in mainstream earnings. Notice how Dan ties robotics back to Jensen again. He is basically saying autonomous and robotics will be front and center, and NVIDIA's platform story is part of that. This is another example of the ecosystem thinking. Even if you are bullish on a robotics company, it often still ties back to the compute stack, the sensors, the simulation, the training, and the edge deployment. NVIDIA, again, remains part of the plumbing. Then the interview gets into something more technical that a lot of investors have been hearing more about lately, RPOs, remaining purchase obligations. The host even jokes that it is not the run-pass option from football, it is remaining purchase obligations. This is important because RPO is one of those accounting terms that can quietly signal future demand, especially in cloud and enterprise contracting. In simple terms, it is a measure of contracted commitments that are expected to be recognized as revenue over time, but it is not identical to revenue, and it is not a guarantee of revenue. The host references a huge OpenAI contract with Oracle and mentions seeing a massive purchase obligation number, described as around $500 billion in the transcript. Then he says the market called BS on it, meaning investors were skeptical about whether those commitments would actually convert into realized revenue. And he asks, do we expect some of these contracts not to come to fruition? Dan's response is basically an Oracle bull case framed through RPO skepticism. He says that if we sit here a year from now, one of the names that will stand out is Oracle, and he describes it as a renaissance. That is a strong word. He is telling you he believes Oracle is underappreciated as an AI infrastructure and cloud beneficiary, and he pushes back against the idea that investors should dismiss RPOs as fake numbers. He argues that the growth reacceleration could be dramatic, with growth going from something like 18% to 30% to 45%, and he says he thinks 80 to 90% of that gets done. In other words, he believes most of the contracted commitments convert, even if you haircut a portion for caution. This part of the interview is really about how you interpret signals in the AI capex boom. RPOs can be a proxy for future workload demand, but they come with caveats. They can include multi-year commitments, they can be subject to changes in project scope, and they can be recognized over time. So a giant RPO number does not mean next quarter revenue explodes, but it can mean that the pipeline of work is real and the customer intent is there. My reaction here is to treat RPO like a leading indicator, not a promise. If you see RPOs rising sharply, it supports the narrative that customers are signing up for AI infrastructure, cloud capacity, and long-term consumption, but you still need to watch how it converts into revenue, how it impacts margins, and what the capital intensity looks like. Because with AI infrastructure, the big hidden variable is capex. How much do they have to spend to deliver the contracted services? What does that do to free cash flow? How fast do they scale data centers? And do they maintain pricing and utilization? That is where the real investment story lives. And Oracle specifically is interesting in this framework because it represents a non-obvious AI beneficiary. People tend to default to Microsoft, Amazon, Google, Nvidia. Oracle is often left out of the first sentence. Dan is basically saying the market is missing the shift. If Oracle is getting meaningful AI-related workloads and signing big commitments, then Oracle can re-rate, and the growth profile can change. That is what he means by renaissance. In the market, a renaissance stock is one where perception shifts from slow legacy to credible growth, and the multiple expands. So when you zoom out, the entire interview is Dan Ives telling you that AI is no longer a one-company trade, and it is also no longer a one-layer trade. We started with the Godfather layer, the chips. Now we are moving through hyperscalers, consumer platforms, enterprise software, cybersecurity, robotics, and cloud infrastructure names that are quietly turning into AI capacity providers. That is why he is so bullish on tech. He sees the ripple effects just starting, and he thinks the market will increasingly reward the companies that can show real monetization and real contracted demand. If you want to turn this into actionable takeaways for your investing process, here is the clean way to think about it. 1. The AI theme is broadening, so build your exposure across layers, not just one ticker. 2. If you are chasing expensive AI software names, you need to monitor execution closely because the valuation assumes a lot of future success. 3. Keep an eye on CES and the robotics narrative because that is where the next category can get priced in early, especially if autonomy becomes a mainstream enterprise spend line item. 4. Understand the difference between a headline contract number and realized revenue, and use metrics like RPO as signals that need confirmation through future quarters. And 5. Watch for the renaissance candidates, the names that the market has not fully re-rated yet, because those are often where the biggest multiple expansion can happen if the story turns into numbers. That is the heart of what Dan Ives is saying here. Nvidia remains the center of gravity. But the market is moving into the second and third waves. The easy money was being early on the infrastructure build. The next money is identifying where the adoption, monetization, and contracts are accelerating across the ecosystem, and staying disciplined about valuations while you ride the trend. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's dive into the top 5 tech stocks to own heading into 2026, according to Tom Lee. First up, Microsoft, ticker symbol MSFT. This is a company that needs no introduction, but let's take a closer look at why it's not just a tech giant, but a foundational pillar of the modern digital world. You know them for Windows and Office, the software that powers millions of homes, schools, and businesses around the globe. These products are so deeply embedded in our daily lives that it's hard to imagine a world without them. But that's just the start. Microsoft's reach extends far beyond the familiar blue screens and productivity tools. From Surface devices to developer tools, their ecosystem touches nearly every aspect of technology. Microsoft dominates traditional software, but their real power today is in cloud computing. Azure, their cloud platform, is a direct rival to Amazon Web Services and serves as a backbone for countless businesses, governments, and startups. Azure's growth has been explosive, and it's now a critical part of the digital economy, powering everything from small apps to massive enterprise solutions. Their investment in OpenAI and the integration of artificial intelligence into Bing, Azure, and Office is turning AI from a buzzword into real, tangible revenue. Microsoft is at the forefront of the AI revolution, embedding smart features into its products and making advanced AI accessible to businesses and consumers alike. Microsoft's three pillars, legacy, software, high-growth cloud, and cutting-edge AI, make it a rare blend of stability and innovation. Few companies can claim such a strong foundation while also leading the charge into the future of technology. Their financials are rock solid. We're talking about consistent double-digit revenue growth, huge profit margins, and a fortress-like balance sheet. Microsoft generates massive free cash flow, giving it the flexibility to invest in new opportunities, return capital to shareholders, and weather any economic storm. Satya Nadella's leadership has been nothing short of transformative. Since taking the helm, he's shifted Microsoft's focus to the cloud, embraced open source, and fostered a culture of innovation. Under his vision, Microsoft has become the world's most valuable company, consistently staying ahead of tech trends and setting the pace for the industry. Their competitive moat is massive. High switching costs keep customers locked in. Network effects make their platforms more valuable as more people use them. And the sheer power of the Microsoft brand makes it nearly impossible for competitors to catch up. Their products are deeply integrated into the workflows of organizations worldwide, making Microsoft indispensable. Don't overlook gaming. With Xbox, Microsoft has built a loyal community of gamers, and the recent acquisition of Activision Blizzard positions them as a dominant force in the booming gaming industry. This move not only expands their content library, but also strengthens their presence in cloud gaming and esports, opening up new revenue streams for years to come. Looking ahead to 2026, expect AI to drive profits even higher, Azure to keep growing as businesses migrate to the cloud, and Microsoft's ecosystem to become even more indispensable. The company is investing heavily in research and development, ensuring it remains at the cutting edge of technology and continues to shape the future. Microsoft isn't just a stock, it's the foundation of a future-proof portfolio. Its resilience, adaptability, and relentless drive for innovation make it a cornerstone investment for anyone looking to build long-term wealth in the tech sector. If you want both safety and innovation, MSFT is a must-watch. It offers the rare combination of reliable returns and exposure to the most exciting trends in technology, from AI to cloud to gaming. The numbers, the leadership, and the strategy all point to one thing. Microsoft is built to last and built to grow. It's a company that has reinvented itself time and again, proving its ability to adapt and thrive no matter what the future holds. This is a stock you can own with confidence, knowing that Microsoft's innovation, scale, and vision will keep it at the forefront of technology for decades to come. Next up, we have Apple. Ticker AAPL. When you think of Apple, you probably picture more than just a company that makes phones and computers. Apple is a global phenomenon, a brand that has shaped the way we live, work, and connect with each other. More than a tech company, Apple is a cultural icon and a financial powerhouse. Its products are instantly recognizable, and its stores are destinations in themselves, drawing crowds from all over the world. Apple's influence stretches far beyond Silicon Valley, touching nearly every aspect of modern life. The secret behind Apple's enduring success? The Apple ecosystem. Once you buy an iPhone, you're likely to get an Apple Watch, AirPods, and a Mac. Everything works together seamlessly, locking in customer loyalty. This interconnected experience makes it hard for users to switch to other brands, creating a powerful network effect that keeps people coming back. This loyalty gives Apple unmatched pricing power and sky-high profit margins. People are willing to pay a premium for Apple products, not just for the hardware, but for the experience, the design, and the status that comes with owning an Apple device. But Apple's real growth engine is services, App Store, Apple Music, iCloud, Apple TV Plus, and more. These services generate recurring high-margin revenue, and they're growing faster than the hardware business. Every time you buy an app, stream a song, or back up your photos, you're contributing to Apple's bottom line. With over 2 billion active devices worldwide, Apple's services reach an enormous audience. This recurring revenue stream is incredibly valuable. providing stability and growth even when hardware sales fluctuate. It's a business model that most competitors can only dream of. Apple perfects and integrates technology, setting the standard in every category they enter. Just look at the Apple Watch and AirPods. These products have redefined their markets, becoming must-haves for millions. Apple's focus on design, usability, and innovation keeps them ahead of the curve. The Vision Pro is their next big bet, aiming to make spatial computing mainstream. Apple is investing heavily in augmented and virtual reality, hoping to create the next platform shift, just as they did with the iPhone. If successful, Vision Pro could open up entirely new markets and experiences. Financially, Apple is a fortress, massive cash reserves, relentless buybacks, and the world's most valuable brand. Their balance sheet is the envy of the industry, giving them the flexibility to invest in innovation, return capital to shareholders, and weather any economic storm. By 2026, expect services to be an even bigger part of their revenue, new product categories to gain traction, and AI to enhance their core devices. Apple is quietly building advanced AI features into its ecosystem, making devices smarter, more personal, and more indispensable. Apple's combination of brand, ecosystem, and innovation makes it a long-term winner. Few companies can match Apple's ability to reinvent itself and set trends that others follow. Their product launches are global events, and their influence only continues to grow. They define the consumer tech experience for billions. From students to CEOs, from artists to engineers, Apple's products are woven into the fabric of daily life. Their reach is truly global, and their impact is undeniable. Owning Apple is a bet on continued excellence in the world's stickiest ecosystem. For investors, it's a rare combination of growth, stability, and innovation, a company that keeps delivering year after year. For any portfolio, Apple is a must-have. Whether you're a seasoned investor or just starting out, Apple offers a blend of reliability and upside that's hard to beat. They're not just keeping up, they're setting the pace for the entire industry, and showing no signs of slowing down. Now, for something different, Palantir, ticker PLTR, the big data pioneer powering governments and corporations. Palantir's platforms, Gotham for government and Foundry for business, turn chaotic data into actionable insights, making them indispensable to clients. Their government contracts are sticky and hard to displace, but the real growth is in commercial clients, industries like healthcare, finance, and manufacturing. Palantir's software becomes the backbone of operations, making switching nearly impossible. They're now scaling fast, making their platform more accessible and signing up commercial customers at record speed. Their new AI platform, AIP, lets companies use advanced AI securely on private data, a huge differentiator as AI adoption explodes. Palantir is evolving from a secretive government contractor to a mainstream enterprise software leader. They've hit profitability, are growing revenue, and their commercial business is accelerating. By 2026, expect their commercial side to rival government contracts, with AIP driving new growth. It's a higher risk, higher reward play, but the upside is massive if you believe in the power of data and AI. Palantir is solving the world's hardest data problems, and that's a powerful place to be. For bold investors, PLTR is a unique opportunity. In cybersecurity, CrowdStrike, ticker CRWD, is the digital guardian every company needs. Their Falcon platform uses cloud-native AI to protect millions of devices, detecting threats in real time and learning from every attack. The more customers they have, the smarter their system gets. A powerful network effect. CrowdStrike's subscription model means recurring, resilient revenue, and their land and expand strategy drives rapid growth. Cybersecurity is recession-proof. Companies can't afford to cut protection, making CrowdStrike's business highly resilient. Their leadership team are true experts, constantly innovating to stay ahead of hackers. Financially, they're a hyper-growth machine, fast revenue growth, improving profitability, and expanding into new security areas. By 2026, expect demand to soar as digital transformation and cyber threats accelerate. CrowdStrike is expanding beyond endpoint security to become a full-spectrum cybersecurity platform. Investing in CRWD is a bet on the permanent rise of cybercrime and the best-in-class solution to fight it. They're not just selling software, they're selling peace of mind. As the digital world grows, CrowdStrike will be essential. This is a titan of the new digital age. Finally, let's talk about Serve Robotics, ticker symbol SERV, a company that's on a mission to revolutionize last-mile delivery using fleets of autonomous robots. In a world where speed, efficiency, and cost-effectiveness are more important than ever, Serve is bringing cutting-edge robotics to the sidewalks of our cities, aiming to change the way goods move from local businesses to your doorstep. The last mile is notoriously the most expensive and logistically challenging part of the delivery process. Traffic congestion, parking issues, and labor costs all add up, making it a headache for retailers and delivery companies alike. traditional delivery vans and human couriers struggle to keep up with the growing demand for fast, affordable service. Serve's robots are already making a difference in cities like Los Angeles, where they're delivering food and packages for major partners such as Uber Eats. These compact, electric robots quietly zip along sidewalks, dodging pedestrians and navigating busy intersections, all while slashing delivery costs and boosting efficiency for their partners. Each Serve robot is packed with advanced technology. Think LiDAR, cameras, and ultrasonic sensors, allowing them to see their surroundings in real time. They operate with a blend of autonomy and remote human supervision, so if a robot encounters a tricky situation, a human operator can step in and guide it remotely. This hybrid approach ensures safety and reliability, even in the unpredictable environment of a busy city. Serve Robotics actually spun out from Postmates after Uber acquired the company, and Uber remains both a major investor and a key customer. This close relationship gives Serve a significant edge, providing access to a huge delivery network and a steady stream of business as they scale up. The opportunity here is enormous. Globally, last-mile delivery is a market worth hundreds of billions of dollars, and it's only getting bigger as e-commerce and food delivery continue to grow. Cities everywhere are searching for smarter, greener solutions to urban logistics. If Serve can capture even a small fraction of this massive market, the potential upside for investors is huge. Just a few percentage points of market share could translate into hundreds of millions in annual revenue. Of course, there are real risks. Building and deploying these robots requires significant capital investment, and the regulatory landscape for sidewalk robots is still evolving. Plus, competition is fierce, with both startups and established giants eyeing the same prize. But Serve's partnership with Uber gives them a head start and a powerful ally in navigating these challenges. Looking ahead to 2026, Serve plans to expand into more cities, grow its robot fleet, and add new delivery partners. As urban populations rise and demand for fast, contactless delivery increases, Serve is positioning itself to be at the forefront of this transformation. If Serve can execute on its vision, it could fundamentally transform urban logistics, making deliveries faster, cheaper, and more sustainable. The company could become a critical part of the infrastructure that keeps our cities running. For investors, this is a classic high-risk, high-reward play. The potential for a 10x or even 100x return is real, but so are the challenges and uncertainties that come with pioneering a new industry. For those with a strong appetite for risk and a belief in the future of automation, Serve Robotics represents a bold bet on the next wave of delivery innovation. Imagine a city where robots handle your food and package deliveries, weaving through crowds and traffic to bring what you need right to your door. That future isn't science fiction, it's already starting to happen, and Serve is leading the charge. If Serve succeeds, it could completely redefine the last mile, making urban delivery smarter, cleaner, and more efficient than ever before. There you have it. The 5 tech titans I believe are set for incredible growth by 2026. Microsoft, Apple, Palantir, CrowdStrike, and Serve Robotics. Want deeper research, exclusive tips, and real-time alerts? Join the Stocks Galore Patreon, link in the description. Now, which of these 5 do you think has the most hidden potential? Drop your answer in the comments. I read everyone. Don't forget to like, comment, and subscribe for more investing insights. Thanks for watching. See you in the next one.